businesses. He counsels entrepreneurial ventures in a broad array of areas such as accounting, tax, finance, and strategic planning. Please welcome William Rush.
Thank you. Good morning, everyone.
Good morning.
Welcome to day one here in Las Vegas. What I'll assure you in my topics here is that we won't put you to sleep. We're not going to talk about alternative minimum tax. We're not going to talk about dependent care tax credits, earned income credit. Those are some of the more drudge areas of tax. I tend to try to focus on the new, more innovative areas, what your clients are doing that they may not tell you about, this new innovative economy. When you came here, how many of you used an Uber? Uber or Lyft to arrive here? Taxi. But more and more. Maybe a year ago, hardly anyone, but now about a third. I assure you about a year or two from now, it'll probably be 2/3. But see, what we're trying to do is take some of this journey is that it's kind of changed the rules for what we're used to in terms of taxation. Because as many of you are aware, a lot of our rules for tax are based upon decades-old law, but now we're in 2017. So today we are going to talk about business as we're doing business in a multi-state and as well as international perspective. How many of you here have customers who sell on Amazon? Raise your hand. Quite a few. You know, about 10 years ago when I did a topic like this, you know what most people said? What's that? That was 10 years ago. And as you look around the room, more than half has a client selling on Amazon. I bet you 5 years from now, you're going to get a question. Do I need to file VAT? No one knows what it is. Value-added tax. Most countries around the world have it. But we don't have it in the United States. But those of you selling on Amazon eventually will have to. That's how the world is changing. So today we're going to break down the topic into 4 parts. We're going to talk about in the first segment Nexus. We'll talk about apportionment, special hot topics that are hot button issues among states, and then we'll end up today's workshop talking about doing business abroad. If you have any questions during the workshop, feel free to raise your hand. This is a long, lengthy workshop. We can deep dive in any specific particular issues that you're having questions or problems with. If you ever have questions, feel free to give me a call at any time or email. I'm here to help you out as best I can. I've been a member of CSTC for about 17 years now. And I have learned from many of you, I've learned from many of you here as well, so I love to answer anyone's questions. So feel free to reach out to me anytime. So the first topic we're going to talk about Nexus. And Nexus is not what we are all used to. It's kind of changed a bit. Most of you kind of think of Nexus as being physically someplace, right? Is that what most of your understanding of Nexus is? I physically have an office in the state of Nevada. I physically hire some employees in Utah. Is that kind of correct? Well, this kind of goes back to a lot of the laws were based in the 1950s and 60s. And those of you who are Star Wars fans, okay? Those of you who are Star Wars fans, we remember a time when people shopped at the mall, right? That's where they did all their shopping. Nexus was easy. You walked into a mall, you bought all your products. The mall was located at a specific place. Seems pretty easy. But these darn things change the world, right? Your kids, your grandkids, you don't recognize them anymore, right? They're space aliens. They're on these things. And that's how people are doing their shopping. They're buying everything. And thus, business across borders. We're a borderless economy now because of these things. You don't need to go here anymore when you can shop on this screen. So the challenge is that our tax rules have failed to keep up because many of the tax rules are based in the 1950s and 60s, and we're in 2017. As a result, many states are feeling pressure because of the likes of Amazon, eBay, your direct sellers, who are preferring to shop online. So as you see in terms of a breakdown of revenues, focus on the graphic here just in terms of the sales tax makes up 1/3 of state revenues. 1/3. When we add in the excise taxes, we're over at 45%. Okay? That's why this is big stakes. See, the income tax that a lot of us deal with is only 36%. And then corporate income taxes are about 4%. So that's where a lot of the money is and where we're seeing a lot of the erosion of the tax base among the states. Here is when we're looking at in terms of a graphic of what the typical sales tax rate is across the U.S. We're going to focus a lot on California today, so you can get your California credits. We're an average of 8.48%, whereas if you look at Texas, 8.17, Kansas, 8.60. Most states are kind of within that range, but the point is, most states derive a significant portion of revenue from sales tax. That's where the money is, but that's also where all the revenues have been eroding away. So when we look at our last financial crisis from the period of 2008 and 2009, look at how many states still have yet to recover their tax revenues. California's recovered, but look at all the red. Do you notice a lot of the red throughout the U.S.? That's from 2009 up until present. States that have yet to have recovered in terms of their tax collections. That's what this graphic means. And so we're basically in a situation where states have to kind of look and rethink the rules, how we redefine nexus. So when we go back to the traditional rules of nexus that we're accustomed to, basically we're talking about the degree of business activity that must be present in a state before the state can lawfully tax one's income, okay? But that definition of that degree of activity is what has evolved and what we're going to talk about in a moment. So what you have to basically, as the takeaway here, if you have no nexus in a state, then you don't have any obligation to pay or file in that state. Plain and simple, period. You must have nexus. So where a lot of nexus that we're operating off of is based upon, it's predicated off of Public Law 86-272, which was a Supreme Court case in 1992 from Quill versus the state of North Dakota. And the case was basically settled along establishing various physical nexus standards. So basically what the purpose was to establish a basic threshold when we're thinking in terms of for a taxpayer to have nexus in a state that must exist. But what I want you to keep in mind in terms of Public Law 86-272 is that it doesn't cover sales tax, doesn't cover gross receipts tax. Many states have a gross receipts tax, not an income tax, okay? Like Texas, franchise tax is a gross receipt. Washington is a gross receipts tax. Nevada is a gross receipts tax, okay? Not applicable to Public Law 86-272. Yes, sir?
I hate to interrupt. Do you have your wireless microphone on?
I wasn't given the microphone. I just have the microphone here. Oops.
There you go. Now, once you put it on, I may have to adjust the volume down.
Okay.
Is that better?
Ooh, that's a little high.
Whoa.
Keep talking. Cameron.
I
don't want to kind of ring up my ears. So normally I speak loud. So it's basically what we're talking about is that it doesn't cover gross receipts tax, it doesn't cover excise tax when we're talking about fuel taxes and all those other special taxes. Those are not covered by the protection of Public Law 86272. In addition, when we're talking about types of sales, we're usually talking about sales other than tangible personal property, what we think about as goods. Again, these are goods. What does everyone sell here? Services. Not protected. You understand? You sell this, protected. Sell services like us, not protected. That's the difference. Sales other than tangible personal property. And what kind of clients are you getting lately? More and more service or more and more selling goods? What's been the last 10 years like? Service. Because it's evolving and more people are selling service. So thus, more and more people are falling out of the protection afforded by Public Law 86272. So the first nexus concept that we're going to talk about is attributional nexus. Okay, so in its basic sense, a business operates a retail store in a state and has an e-commerce store selling the same products. I'm sure you're all familiar with this. You've seen Walmart, Walmart.com, right? You've seen Best Buy, BestBuy.com, Costco, Costco.com, so on and so forth. That's what they mean by attributional nexus. It's plain and simple saying, you can't fool us by having a store and an online presence and say that the two are different. Because essentially what it's saying is they're both one and the same. So if you're going to have a store in the state and you're going to sell online, it just means that the online seller should be collecting sales tax. They can't say, no, that's just the store only. Because that's what a lot of the stores used to try to do 10 years ago. There was Borders Books. They're not around anymore. Barnes & Noble, Circuit City. Many of them had an online presence, but they also had stores in the state. And when you shopped on their website, they weren't collecting sales tax. So attributional nexus says, no, it's one and the same. Okay? It's plain and simple. Okay, we're going to talk about click-through nexus. Click-through nexus is a real hot button. Just basically what it means is that when a business drives traffic to another business's website by placing banner ads. I'm sure as you've been on an internet site, you've seen banner ads, little coupons that you click on, that you try to get a deal. Businesses do that because they try to make money, because they try to drive traffic to another site to get a commission, or there's a certain amount of ad revenue. So there's a business reason in terms of doing that. But here's the catch, what it means for that merchant who's receiving the traffic. Because when we're talking about click-through nexus, we're talking about the merchant who's receiving the traffic. Okay? So I'm going to pick on Mike, for example. Let's say Mike puts ads on his website, and I'm going to sell QuickBooks to the world. And he's driving traffic, and I'm based in the state of Utah. Okay? Mike's in Orange County. See, I'm giving Mike revenue and incentive to do that, but now I have a nexus in California, even though I'm in Utah. Does that make sense? See, I'm being pulled into the site operator where he's pushing traffic. Okay? So this is a typical example in our business of you go out to different companies that sell tax research and different things, and what they're trying to do is obviously promote other types of products and services from other companies. Well, this company here, you know, mileage apps and different form calculators, they're going to earn money off of this. The point what I'm trying to get across is this is a graphic example of click-through nexus, that this company based in California, that if the software company, for example, here is based in Australia, if the mileage app company is based in New York, they're all going to have a California nexus. That's just what it means. Because this company, this site operator is in California. Okay? That's how the landmark has changed. And we have over 20 states now that have adopted some form of a click-through nexus law. So as we look at here, California, any particular states that you're looking at, we're currently in Nevada right now, New Jersey, New York, Ohio, Pennsylvania, Rhode Island, Tennessee. This is as of 2017. This is currently expanding where pretty much we'll have most of the U.S. adopting some sort of click-through nexus legislation. Okay, affiliate nexus. Affiliate nexus is just basically when a business is utilizing affiliated parties, and the affiliated parties have some physical presence in the state. You probably have heard clients, they try to be creative, right? And they say, well, we're based in Florida, but I've got these sales reps who are going to go through Orange County, LA, Riverside County, right, to market my product. And they're going to go and store my product. They're going to receive the orders and ship them out, okay? You have examples like that? You ever hear those examples often? Yes?
Yeah, I have a client who is an architect and he's based in California, but he has an office in Arizona.
An office in Arizona. And in California, what's the activity or what are they doing in California that they're not?
He's doing activity in both states.
Okay.
So I really explained to him that he has responsibilities
Right.
to Arizona and California.
Right. And you probably find a lot of clients, like for example, this is very common with e-commerce, is that people can easily operate their business from their bedroom. And no one stores their products in their home, but they find someone to basically store the products for them and take the orders and ship them out. This is what we're meaning by affiliates, because those people have the physical goods. That's your property. It's located in another state, and it's kind of one extension of you. That's what we mean by an affiliate, an extension of you. So kind of like agent. And you probably hear this over and over, but what if they're a 1099? What if they're this? This is the point of affiliate nexus. We're going to another degree of separation who's not necessarily on your payroll, okay? And this is how it's evolved. I have a lot of clients who actually send out installers. And not all the installers are what we call paycheck W-2. They could be contract people that are from other companies who are certified, who go and do the installation. And as well as technicians. Whenever you need to go get service on an existing or troubleshooting on your product or any type of installation. Anyone ever have that? That they have installers and technicians, but they're not from the company's payroll, but they're utilizing some sort of group of affiliates? These again are examples how it would draw a nexus to that business in another state. Economic nexus is one of the latest iterations of basically moving beyond physical presence. And basically what it means in a nutshell is that it's basically to say, if you are incurring over a certain level of economic activity in the state, typically gross sales volume, it's basically inferred that you must have nexus. Even though you physically have no offices, physically have no employees, physically have no property. Give you an example. You could be a company based in San Diego. I have many clients based in San Diego, but they make a lot of sales in the state of Ohio. They make a lot of sales in the state of New Jersey, more than $1 million. That's the idea of economic nexus, is that they're just basically making the inference, well, you need our customers in order to conduct business. And so far right now, we have about 8 states that have enacted economic nexus legislation. This is an emerging issue at the moment, so I would envision over the next 5 years you'll probably see 20 or more states. But right now we just have Alabama, Indiana, Massachusetts, Tennessee, Vermont, and Washington so far. Yes, sir.
Are you talking about the business based in San Diego that has telemarketers in San Diego selling to Ohio?
No, website.
A website.
Yeah, like for example, I have some clients that sell sewing machines, and they do really well. They sell about $20 million a year, and people are just going on the website clicking to buy a sewing machine. And they could be selling more than like $1 million of revenue a year in the state of New Jersey. Or, say more than 500,000 in the state of Indiana. What economic nexus is basically saying is that, well, if you're incurring that amount of sales volume, even though it's on a website, we don't have a telemarketer, we don't have anything in that state, the state's trying to imply you have a substantial amount present because of the economic activity. That's the inference that's made by
So
that.
for example, I have a client who sells pool tables.
Mhm.
They have a website, and they're purchasing from Florida to all locations from
Correct.
there, and he sends them out. So basically, if he has 10 states that he's dealing with and selling well over $1 million in sales on each one, then those would have economic.
That's correct. And the economic nexus, let's say, what's your name, sir? As what Eddie's talking about, the states try to basically codify to say what we call the threshold level could be 250,000 sales or 500,000 sales. So basically, the state establishes what we call the floor. So if you, in a year, have more than, say, 250,000 gross revenues, then it's implied that you have nexus. That's how it works.
And is this referring to sales tax or also income tax?
It is both.
Both.
Yeah, that's correct. Because usually what we're talking about is to have, some sort of basic nexus in the state. The immediate nexus, what you'll have more exposures on the sales tax side than on an income tax side. And we'll talk about apportionment methods, but in theory you'd have a nexus for both. The difference is how you apportion the sales. Okay?
Where would we look up those
Yes.
thresholds?
Oh.
Do you have somewhere where we look up those thresholds that you're talking about? Is there a place we can look that up? Like the 250 floor and so on and so forth?
Yeah, a good link and reference that I use is salestaxinstitute.com. They keep current legislation for different nexus rules, and on there they hyperlink back to the individual state. Because this is kind of like in a real-time basis updating. Because like, for example, Indiana can pass the law, but it got defeated in the courts as being unconstitutional. So it's kind of an ongoing thing. So that's what I normally reference. Yeah. Yes, ma'am.
So I'm getting the impression that Nexus, the purpose of Nexus, it will allow the state to shift the responsibility of collecting these taxes to the seller and then passing it through to the state rather than relying on the consumer
Correct.
to pay a use tax.
How long have you been in practice, ma'am?
Since 2003.
Since 2003. So in 14 years, how many of your clients do you recall saying, I bought something online on
Oh, they
Craigslist
don't.
and I need to pay use tax? They
I
don't even know
have
what it is.
one.
One, right?
One client.
And that's a real issue because the states, when they're seeing in terms of their revenues declining, the thought process is we need to put the onus on sellers more so than consumers because all the efforts. How many of you remember there was the registration for use tax for service providers in California? That we did it for a couple years and there was so much blowback from BOE. See, this is not a new issue that states have tried and tried to get people, will you please voluntarily disclose? And it just doesn't work. So this is where we're at today, is basically to push more and more lawfully of remote out-of-state sellers selling into a state to put the burden on them without any what we call federal legislation. Because we're operating in a world where we haven't had any federal legislation. Supreme Court, which was Quill, 1992, said they want to leave that to Congress. Congress hasn't acted yet. So this is where we're at. States are legislating individually the nexus laws. And what is created is a patchwork of confusion because each state's kind of legislating their own interpretation. But again, the point is, how can I nab an out-of-state seller to basically collect on behalf of my in-state consumers who are not paying their fair share? Okay. Marketplace nexus. What's that? You buy on Amazon.com? Yes, ma'am. Salestaxinstitute.com. Salestaxinstitute.com. Yeah, that's my reference for real-time nexus and legislation. So marketplace nexus, we try to think about, you like to buy on Amazon, you like to buy on Craigslist, you like to buy on eBay. Those are what we call marketplaces, right? And marketplaces are typically made up of independent sellers. So the purpose is just think of it as a shopping mall, but on the internet, okay? That's all that a marketplace is. It's a popular domain that you go on to Amazon, Airbnb. Any clients have property on Airbnb? Few. Those are marketplaces. I list my property up on Airbnb to rent, like as a hotel stay. And they're well known, they drive a lot of traffic. So basically, the assumption is that this marketplace, without the marketplace in existence, you wouldn't have access to customers in the state. Arizona, Nevada, Colorado, California, New Mexico. That's the whole premise behind Marketplace Nexus. Your client who sells on the marketplace may think, I'm never in the state of Arizona, but Marketplace Nexus says, yeah, but Amazon is. You're on Airbnb, Airbnb is. You're on eBay, eBay is. Does that make sense? That's the difference. And the teeth behind it is, it's made up of millions of sellers. So for me as a state, it would be very hard to go after the individual Amazon seller. But I can go after Amazon.com. I can go after eBay. I can go after Airbnb. That's basically the hook, that they go directly to the site operator. And that's what has changed. And you're going to see this more and more over the years, is that either the site operator is going to be collecting the tax, or they're going to shift the responsibility to the seller saying, you have all full liability, you better take care of it. That's why, as I stated at the beginning, are you prepared for VAT? And most people don't know what it is. Because eventually it's going to come at a point, if the site like Amazon doesn't do it, the seller has to take care of it. Okay? Arizona right now is the only state so far that has enacted marketplace nexus legislation, but there are a handful of states right now that basically have bills moving through their legislatures trying to enact it. Okay, so one question that I get a lot from clients, and you probably get it as well, when they start to basically do business in another state, and we have this conversation about Nexus, what happens if I stop selling there? Maybe make a bunch of sales in 1 year, and then I really don't do business anymore. So basically, when we look at the map, how long after we engage in that activity that my nexus stops? So let's focus on California. California in red is indefinitely. Okay? So once I have nexus in California, I don't necessarily say that 3-4 years afterwards that my nexus has ceased. Whereas others could be just a calendar year. Okay? So you have these maps in your handout, but this is something that's good to reference because you always want to kind of understand for yourself when you're advising a client and they're going to start filing in a new state. They're also going to ask questions, what happens if just business changes and my sales activity goes down? You want to understand the full picture. How long will I have to keep filing that state? Yes, sir?
If you're filing a sales tax return in the state, they will always tax you until you file a sales tax return with zero sales and say you're not in business in this state in 2017. Otherwise, you will get late notices.
Correct. You'll get late notices.
You have to make a final return.
Right.
Basically.
Right.
Zero sales.
Right.
In each state that you have filed previously.
Yes, you have to continue to file zero returns. But the point that I was trying to make is that each state takes a different position of how long after your activity ceases does basically the nexus stop, or does it continue? And so some states could just be a calendar year, others could be a series year. What I wanted to point out, California, which most of us are from California, is indefinite. Okay? Yes, ma'am.
On that point, if a California company moves out of California and they have Nexus indefinitely, will they continue to pay California tax on all sales like they did when they were here, or only on California source
Well, the good
sales?
thing is with California, you can apportion, but it would be on the California source. But the other key thing, just as an advice, a lot of your California clients, assuming they're incorporated in the state of California, what we call a domestic corporation, they move out, I advise that they should refile. So let's say they go to Wyoming, that they refile in Wyoming. And so basically, if you're going to operate in California, you're now a foreign corporation, not being domestic.
In other words, close down the California corporation.
Exactly, because a lot of clients, they don't look at the connection here, is that we maintain our existing corporation, but we've moved our headquarters, we've moved our operations out of California. But I'm still filed with the Secretary of State as a domestic corporation. My advice is the new state you move into, you basically refile what we call a domicile as a domestic corporation. And then basically, if you're still going to do business in California, you file as a foreign corp, or you do what's called the dissolution. That would be the best optimal mechanic. Because otherwise, the Franchise Tax Board is going to try to still penetrate through as though you haven't fully closed it out.
Oh, right.
You see? So you want to kind of close out the chain to prove, because we've moved out our physical property. We don't have, in terms of any people, payroll, or any other presence. Okay? Now, with that said, that doesn't necessarily mean, moving on, that we're not going to have exposure to California, because I want to talk about some changes when we get to marketplace sourcing. But I'm talking about how we're shifting when we're moving from one state to another, how to do it properly. Okay? So when we think about a lot of our clients who are not in compliance and they're selling in all these states, how do the states go about tracking people down that are selling in their state? Anyone have any ideas? Huh? Audits?
Credit card.
Credit cards? High-speed chase? High-speed chase? Highway patrol? Seek them out? Huh? Whistle? Yes, sir.
Post office.
Post office?
Yes.
Well, as we're here in Las Vegas, there are a lot of conventions. And you have trade show exhibitors and you have people soliciting products and services. Well, it's open to the public, right? So a Franchise Tax Board, Department of Revenue, as most states have them, they go in and start asking questions, posing as a customer. You also, a lot of products, they get shipped through trucking companies, you have bills of lading, you have ports, you have marinas, right? Sometimes in California we have physical borders like US Customs. But actually, one of the most common is actually as a result of an audit from another taxpayer. That's the most common method. And a lot of your clients, you may not realize it, they do business with big companies. Big companies get audited all the time. And one of the purpose in most audits, besides verifying the compliance of a taxpayer, it's also to look for additional, what we call audit leads. So as you're going through, and how many of you do representation here? Good portion of you. You probably get this question a lot. Who are your significant suppliers, right? Who are your significant customers? Besides asking about your bank account and your merchant account and so on and so forth. The purpose of these questions is to identify potential targets so that they can go out and initiate audits. And that's the most common reason that your client actually gets targeted as a result of one of these, what we call a chain audit. So once a state audit task force has identified their leads, they typically will send out a Nexus questionnaire. And this is the most common enforcement tool used out there by states. They do these form mailers out to states that they believe that are operating in their state, just basically saying, you know, dear so-and-so, will you please fill out this Nexus questionnaire? It sounds very innocent and innocuous. How many of you have had a client approach you about the Nexus questionnaire?
Never seen one.
None?
Never seen one.
Never seen one? Well, this is a good opportunity to learn what one looks like, because they're a very common tool and method, and if your clients don't tell you about it, you have to be careful in how you're answering it, because if you answer it inadvertently, it would be deemed as though you're doing business in that state. But this is basically the tool that they use based on your answers in this questionnaire to mark in their system, you need to be registered and filing and paying taxes. So this is the base point. So it's broken down into looking into, as we'll go through the Nexus questionnaire, operations. So we go through the physical presence questions, whether you have office, employees, do you own any physical type of equipment, you have rents or lease, okay, the basic straightforward ones. Vehicles is a common one. You probably have clients who deliver, and they may end up delivering and crossing state lines, okay? This could be a common one. So how often each year do you use company vehicles to deliver product to customers in the destination state? Telecommunications, there are a lot of companies that provide some form of a telecommunications service. And again, this is specifically geared towards telecommunications. Okay, so let's talk about sales and marketing. Sales and marketing is the most common one because, again, we're in Las Vegas, and in Las Vegas there are a lot of conventions, like in a lot of cities, and a lot of companies come from other states, right? And they're not based in Nevada. So again, it's how often do you send company employees into a destination state to build customers. It's basically to solicit orders, okay? And most of you guys have like a county fair. In San Diego, we have what's the Del Mar Fair, which has been a long-run institution. You probably have your local county fairs. Well, you probably go around, you see a lot of vendors that they sell home and garden type of things. You may want to buy some patio furniture, or you may want to buy some items for gardening, landscaping, or a barbecue. A lot of those vendors are from out of state. So if you can imagine, they go to those different events multiple times in a year within one state. So if right now we're doing in San Diego, in a few weeks it could be up in Costa Mesa, then it can go to Pomona Fairgrounds, and then go to Santa Barbara, and so on and so forth. So just think about it. They're not necessarily leaving the state, they're just still in the state. So that's something to keep in mind. A lot of people earn their business by attending fairs. So again, how often each year do your employees attend or exhibit at trade shows in the destination state? Does your company have any call center relationships with personnel located in a destination state? That's really been a big, basically, with a lot of companies today, they're trying to hire to have 24-hour kind of call, or whether it's an answering service. That's really been big amongst a lot of companies. And so just basically because we have different time zones, you may theoretically have people who are working on East Coast, Central Time, and West Coast, and they could be located in different regions. So again, these are questions that come up, and they may as well as be on your payroll or you're using affiliates. Okay? Direct mailing, national advertising, the internet is just kind of the real hot button, because as a lot of people are using Google AdWords, whether they're using Amazon.com or their direct internet, and as we just talked about earlier, or the internet banner ads. Okay, so this is kind of how they're getting towards that when we're talking about the click-through nexus. Now, all the third-party relationships. So most companies, you know, they work with other companies to do shipping. They may work with outside parties to do installation. They may work with outside parties to actually do sales and to represent their products. Okay, so this is kind of looking at all those what we call subcontractors or that web of vendor relationships. And so this is the one you want to think about. And this is the actual area where I've had, over the last dozen years of a number of clients who ended up getting nabbed for basically because they're sending out different third parties in the States. Because again, I'm going to use an example. I'm from San Diego, and basically the business is not in those other states, but I'll use an example. So I have a client who sells these virtual reality golfing simulators. So what is a virtual reality golfing simulator? Well, imagine if you had a lot of money and you wanted a toy, and you had $40,000 to burn. Some people get a home theater, right? Well, let's say you want to act like you're golfing in Pebble Beach in your living room. Then you want to basically go to, you want, say, Maui or Scotland or another part of the world. That's what a virtual reality, because it puts on the screen in your living room what that golf course looks like, and you're driving in your home. Little driving range. Well, this is not like a kit and a toy that a customer orders and that they assemble, that they receive via mail order. It's a product that has to be professionally installed, because they're putting in this booth material in your room so they're not tearing up your walls, because you're driving an actual golf ball in the home and putting all the net and putting all the flooring. Well, guess what? You're using this web of third-party relationships, even though the customer is ordering from the San Diego company into Florida, into Cleveland, Ohio, okay, into Omaha, Nebraska. And so each state has basically said, you're doing business in the state. You're doing business in the state. Because this is not like a one and done. I order it online, you set it up 10 minutes. It's like a 2 to 3 day project. Or when the product is not working, something's torn or the software's off. Hey, I'm hitting the ball, but it's not tracking the trajectory. It's just off. You have to send out a technician. All those little aspects, again, as though they're doing business in all these states. Does that make sense? And so again, what you have to be careful of is all these little third-party relationships. Because your client may be absolutely adamant and insistent, I'm not doing business in the state. But actually they are, if you start getting into and examining the third-party relationships. Okay? All right. So what are our options to basically get clients in compliance? We can ignore it. That may not be too wise. Why? What happens if we ignore it? Huh? I'm sorry?
Get penalized.
Besides penalize, what happens to our statute of limitations?
They run out.
Huh?
Never starts.
Never starts, but also too, just so that you know, goes back 8 years. Okay? See, one of the benefits of voluntary disclosures, we want to shorten the statute of limitations, because most states have a 4-year statute of limitations. And if you voluntarily disclose, you're starting an actual start date. Okay? But if I never disclose, then they're going back retrospectively 8 years. Does that make sense? So that's the primary advantage. We want to shorten down that window that they can go and exam in terms of that period, besides the penalties that we can be subject to. Okay? So, like I said, the statute of limitations, usually 3 years versus 8, prohibits states from auditing tax periods prior to the business start date. This is the #1 benefit. Okay? By me voluntarily disclosing in a state, I can basically prevent that state from auditing before the start date. If I don't disclose, and as a result of the Nexus questionnaire that we saw in the prior slide, I blow it off, I ignore it, and then they basically make the assertion that you have business presence in that state, then they can go back prior to that. Does everybody understand? Any, yes, sir?
California has a 20-year state of California, they can go back 20 years.
If you don't disclose.
Right.
Correct.
The tax in the state.
Yeah.
A lot of money.
Most.
$400 million audit. And then a $250 million penalty. The tax in the state for under-reporting the state.
On the Michael Jackson estate? Yeah. And so, as the gentleman was talking about in California, again, most states it's 8 years. The other added plus, if you do a voluntary disclosure agreement, is that a lot of states in their amnesty programs, and I encourage you to take advantage when an amnesty program is made available, is that they tend to waive the penalty and often the interest on any taxes that are due. They basically, what they want you to do is to come out of the woodwork, to declare, get your returns filed, and then pay what's due, okay? So that's another plus that I would encourage you to look at if you've got clients who have an exposure to another state. Okay, so if we don't have any questions in regards to Nexus, we're going to move on to our next segment, apportionment. We okay on Nexus? Yes, sir.
Questions for the audits, are they inside images?
I'm sorry.
The questions that you had, ones that had.
For the Nexus questionnaire, should be in the appendix. If not, and you give me your card, I can email you a copy. But it should be in the appendix in there. Okay, apportionment. So, yes, sir.
I just thought something close to home. Okay, so we're income tax preparer, and say like we have an employee who has a sister that lives in New York, and the sister wants to do the employer to do taxes here in California. And then all of a sudden, the sister's sending her neighbors things to do. It's all taken through email, there's no solicitation involved. It's all thorough. Is the tax office responsible for filing income taxes in New York?
Correct. That is correct. And we're going to talk about a further reason and rationale when we get to what's called marketplace sourcing. But let's start with the first aspect. That tax office has nexus in New York. Okay? So as that reason. Okay? Now, apportionment, once we have nexus in a state, we have to determine how to allocate our income to that state. Okay? That's the purpose of apportionment. Now, the rules for apportionment actually goes back to the Uniform Division of Income for Tax Purposes Act, which was established in the late 50s and enacted by most states in the early 1960s. We're in 2017. It's been a long time. So what has happened as a result, there's been an evolution of states evolving from the traditional apportionment methods. So let's talk about the traditional apportionment methods that have been established. We have the equal weighted 3-factor formula, which basically, when you have a client taxpayer, you allocate the applicable amount of property, payroll, and sales in that state, and each one is equally weighted. Okay? Or there's the 3-factor formula, but the sales factor has a higher weighting. Okay? That's what we mean by the enhanced sales factor. And then the current trend amongst most states is evolving from the 3-factor formula, one of the derivatives of it, to what's called a single sales factor. Okay? California is a single sales factor state. Okay? And most states are starting to move in that direction as a result of e-commerce and being able to sell services. As a gentleman was talking about, I can now do clients' taxes from New York because of those factors. more and more states are moving precisely to that reason. Because I may never ever have any equipment, any offices, any payroll in another state. Okay? So let's talk about an example here. So this is how the three-factor formula would work. Okay? So as we see, we break out in terms of from our federal return on the balance sheet, the amount of property, and as I circle in red there, that's California's portion of the property, and that's an average of 12 months. The reason I'm showing you this is how a three-factor formula is done, but California doesn't use the three-factor formula. Other states do, okay? Now as we get down to here, rents are multiplied up by a factor of 8. Okay, so they take your rent for the year and multiply it times 8. The amount of payroll is you allocate. There's the payroll for the federal return and California's portion. And then finally, California sales is a portion of federal sales. And as you have as a result, each one of the factors has an equal weighting. Okay? Is everyone with me? Each one has an equal weighting. Now, let's move to what an enhanced sales factor. Did you have a question? No. Okay. Okay. Now, Arizona has an enhanced sales factor. Okay? So again, we take the amount of sales for the state of Arizona. So this taxpayer had $156,561 of sales to the state of Arizona, and Arizona multiplies that times 8. Okay? You see how they got there? And then they take that factor divided to the federal sales. Federal sales is $4,622,000. And so Arizona's apportionment was 27%. Okay? That's the difference. So when we say enhance, we're just bumping up the amount of sales by a multiplicative factor, and states can vary what that multiplicative factor could be. Okay? All right. Now, here are the apportionment formulas by state. And again, California is a single sales factor state. When we get into the states that are still using the traditional three-factor formulas, if any of you have clients in, say, Tennessee, Oklahoma, Utah, North Dakota, some of the smaller states are still using it. Okay? And then enhanced sales factor states, I have a number of clients in Florida, Massachusetts, Maryland, North Carolina, New Jersey, New York. Okay? Tend to be the bigger, more populous states. But what I want you to look at here in terms of single sales factor states, we have California, Colorado, Connecticut, Georgia. This is what's current as of now. Again, more and more states are updating this. So we have kind of about a dozen states right now that have a single sales factor. Okay? All right. So when we're getting in terms of basically the apportionment, now we have to talk about sales sourcing. Okay? Sales sourcing is the aspect that is critical, and especially given the fact that most states are eventually going to have single sales sourcing as their sole apportionment method. Okay? Now, sourcing for sales tax purposes can differ from that of income tax purposes. Okay? Now, let me repeat again so we have no confusion. Sales sourcing for sales tax purposes can differ from that of income tax purposes. Remember, as I talked about Public Law 86-272? It was solely focused on income tax. So all the other taxes fall outside. Okay? Sales of tangible goods are generally sourced to the destination of the purchaser. Okay? Tangible good. What do we sell? Service, not a tangible good. Okay? So when we sell goods, products, most states basically say it's sourced to the purchaser. Okay? When we have sales of services and intangible goods, that they're sourced to a location where the services were performed based on the cost of performance. This was the traditional method. that was based in the Uniform Division of Income for Tax Purposes Act. This is where it came from, how we determine how to source services, okay? Which was, again, based in the 1950s. So when we determine the cost of performance, we're looking at, again, the gentleman talked about employees in New York. What is my payroll? What's my cost for performing those services in New York? So when we determine to ultimately source that revenue, we have to look at one of the prescribed methods that a state indicates to determine how we basically break the tie. We have a plurality method, a majority method, and a proportionate method. So let's walk through an example, okay? So let's assume ABC Bookkeeping provides online bookkeeping services to small businesses throughout the U.S., okay? Very common, right? ABC is based in California, but employs bookkeepers in California, Oregon, and Utah. ABC performs contract billing services on behalf of several large retirement homes in Arizona. Okay? In 2017, 40% of the bookkeeping cost was attributed to California employees. That's the payroll. Okay? 30% to Utah, and 30% to Oregon. Under the plurality method, all income would be California if the state uses a plurality method, okay? Because California had most. It was 40%, right? That's plurality. If a state uses a majority method, the receipts are sourced nowhere because no state was over 50%, okay? Proportionate would be 40% to California, 30% to Utah, and 30% to Oregon. Where this comes, it basically applies are those states that do not use market-based sourcing, that they're still using the old cost of performance method for allocating services. That's where these methods apply, okay? Market-based sourcing is a new concept, okay? What market-based sourcing says is that sales is sourced in the location of the customer. So if I have a lot of customers in that example that I'm doing business in Arizona, I would be sourcing those sales to Arizona, okay? Just like the tax returns in New York. Anybody do some out-of-state returns? Quite a few, right? That's what market-based sourcing means. So if you've got that mail-in return that they're basically living in Maine, New Hampshire, market-based sourcing says I'm sourcing it to where they live. Because that's where market-based sourcing says that's where the benefit was derived. Okay? The prior method, what we talked about here, okay? Cost of performance is the old rules, what we were used to. Because cost of performance says services are done where I actually do the service. I pay for the cost of performing the service. Okay? Does everyone understand the difference? So as states enact market-based sourcing, they're basically stating this doesn't apply. It doesn't apply where you paid for and incurred the cost to perform the service. But if a state doesn't have market-based sourcing, they're using the traditional method where you incurred your cost, your payroll, your employees to generate that service. Okay? Does that make sense? That's the difference. Okay, so who here is a baseball fan? Few? It's supposed to be our pastime.
We
Any
have
Padre
a
fans? No? Okay. So what do they do at the start of a baseball game? Huh? You have a pitch, right? First pitch, okay? I'm going to throw out, right? So whoever is the honorary person who throws the first pitch, I'm throwing out. And then the catcher throws back, okay? So we're going to talk about throw out and throw back. Okay, so throw out and throw back rules come into play whenever a taxpayer makes a sale into a state that they don't have any nexus. Okay? So imagine baseball. If the state has a throw out rule, you're throwing the opening pitch. If they have a throwback rule, the catcher's throwing it back. Okay? All right. Basically, this is what they refer to as nowhere income. Nowhere income, again, is if I'm making sales into a state that I don't have nexus, in theory, I wouldn't be paying any tax on that money, right? So, thus, the purpose of the rules. We either throw it back or throw it out. Okay? So, let's take a look at the sales factor. Okay. So in the sales factor, we basically take the sales within the state divided by the total sales on your federal return. Okay? Fairly straightforward formula. Now, under a throwback approach, the sale is thrown back into the numerator. Okay? So we're going to use California as an example. So let's say I'm incurring those sales into Colorado and I don't have any nexus in Colorado. Okay? Throwback means I'm adding those sales into California. Okay? That's throwback. Now, throw out, the sale is ignored from total sales. Okay? That's the throw out. Okay? Did I lose anybody?
Yeah.
Huh? You want me to?
Do that again.
Okay, we'll take it from the top. Let's just keep it straightforward, because how it's going to apply to you is when you're getting an apportioning amongst all these states, oftentimes you're going to have income where that client has no nexus. Okay? So the whole purpose is we either throw it back into the home state or we throw it out. Okay? All right. So our sales factor formulas we're starting with, as we showed, was the sales that you had in the state. So let's say California. My California sales divided by the sales on my federal return. So if I'm making those sales into Colorado and we're following a throwback approach, those Colorado sales are added back to California's numerator. Okay? That's what we mean by throwback. Okay? So if I made $150,000 in sales into California and $100,000 of sales into Colorado, we have $250,000 of sales. Okay? You with me now? That's what throwback means. Now, throw out, because each state has a different rule. Throw out means I throw it out of the total federal sales. So if my federal sales were $1 million and I had 100,000 Colorado sales, I would throw out 100 and only have 900,000 sales everywhere. Does that make sense?
This is only for state.
This is state by state apportionment, because when you get into a return and you actually apportion it, you have to look at the throw out, throw back rule. And the whole purpose is where it comes in are those states you made sales that you have no nexus. Okay? Yes, David.
West Virginia was a very difficult state for us to deal with because they have a throwback, and I didn't understand. I used the throw out because I thought they wanted to just get rid of it. They said no. So after 2 hours on the telephone, they helped me understand the throw out and the throw back.
Correct. That's why I use the baseball analogy, so you can visualize in your mind what throw out and throw back means. Ron.
Well,
Where are you going to know whether the state has a throwback or a throw out rule?
The map.
Okay.
I got a slide of the map. Yeah, but what I wanted to do was basically kind of articulate the concept first so that people kind of have a grasp, because you're going to encounter situations where you make sales in a state you have no nexus, and it can't go free. It has to be taxed. So the purpose of the throw out, throw back is to basically make that adjustment. Okay? So as we look at the map, California is going to have a throwback. Okay? So what it just means is those sales I made into Colorado get thrown back to California. Okay? And the red are the true throwouts. So as
Yeah.
David was referring to as West Virginia, we have Maine. Okay? Only a couple are actually throwout. And just throwout just means is reduced from my total sales on a federal. But for our purposes, the most likely scenario is we're going to deal with a throwback, and you're just going to add those states that you made sales into, and let's use California, add it into your California sales. Okay? And that's what it basically means. Okay, so let's talk about sourcing for sales tax. So as I said earlier, sourcing for income tax purposes can differ for that of sales tax purposes. We basically talk about origin-based and destination-based. Origin-based means the tax rate is based on the location of the seller. I'm located in San Diego. If we have origin-based, I'm charging San Diego's rate, 7.75. That's origin-based. If you're a destination-based and I'm shipping to my customer, and let's suppose they're in Dallas, and Dallas is 9.25. That's what destination-based means. So each state has a different rule. Okay. The difference is when we talk usually about remote sellers, just so that you understand, most states tend to follow destination-based sourcing for a remote seller, even though their state may have an origin-based. That usually only applies to in-state sellers. Okay? So I just want to point out that caveat. So California, Arizona, and New Mexico are the only states that allow origin-based sourcing for remote sellers. I know a lot of people pick on California, but this is a huge benefit, is that you get to pretty much charge based on the location of the seller. If you're accustomed to doing multi-state sales tax returns like I am, the vast majority of states are the other way around. It's that destination where the customer is. And thus adds to the complexity of basically preparing returns, calculating rates, and remitting the proper amount of tax. There are a handful of states, though, that permit a flat rate for out-of-state sellers. I know that Indiana is one, Illinois, and as well as Colorado. So a handful of states are doing that for out-of-state remote sellers. Okay. So again, California is an origin-based state. Just the one caveat I want to add about California so we can get our California credits, that's based upon, because the sales tax has different components. We have the state, we have the local, and then we kind of get the county and district. So it's modified, so when we get down to the county and district is what's the destination part, okay? But the sourcing of the state and local aspect is actually origin-based, okay?
What is TaxJar?
TaxJar is a blog that has a lot of ongoing sales tax law. I mentioned earlier salestaxinstitute.com. I also reference a lot Avalara and TaxJar to basically get what's going on in terms of rate changes, law changes, anything going on in terms of the environment of sales and use tax.
With the sales tax, given that we're in this environment of tax reform, I'm seeing this being a far more complex structure moving forward. Is that what you're seeing as well?
Yeah, and what's your name, sir?
Armin?
As Armin's talked about in tax reform, if we put aside the discussion about rates, reducing corporate rates, one caveat potentially has been the Marketplace Fairness Act, which is basically what it's trying to do is once and for all level playing field to define nexus. And somehow how we may get and determine rates. Now the bills and legislation we have doesn't come out with what we call a harmonized rate, but it's basically creating a structure of how to comply, what we call small seller exemption, and then a period of time as basically, let's say the law initiates, you have 10 million above in sales. So the first year of implementation, anyone with 10 million above sales has to comply. Then the second year it's 5 million, and then the third year it's 1 million. But it's not necessarily yet addressing the issue of all the different rates. when we get into the county and the cities and the zip code. That's kind of left out. The ideal would be in a true tax reform, like for example, say Canada. Canada has harmonized their GST rates, and they harmonized a lot of their provincial tax rates as well, so that you're not dealing with all these different rates. That would be the ideal. Because just to give you some perspective, in the U.S., we have approximately 50,000 different tax jurisdictions when it comes down to the sales and use tax. So it's not just a matter of saying, we're going to bring all these people in and require them to file. The challenge is, that's extremely daunting. So we also have to have some sort of reform of, it would be ideal that we have like a flat rate. So let's say California is 7.5% and you're dealing in Illinois 6%, but having one rate as opposed to all the different nuances, that would be ideal.
Well, given your background and what you hear, you're more current with this.
Yeah.
What is the appetite in Congress to act in order to create some kind of harmony from a federal level?
Basically where we're getting the consensus is to bring people out of the woodwork. What we call the compliance aspect. Where we're not, where I would say anywhere near, because in order to make it work, because now I'm talking us, the practitioner, and also too, we're dealing with small business taxpayers, and your cost of compliance can be elevated. We also have to deal with something about rates. Because I don't know if many of you deal with multi-state a lot. So let me give you an example. A lot of the rates are transaction-based, the cost of the software. So if you're using an e-commerce platform on your website and you're calculating rates all throughout the US, the average is $1 a transaction. That's the cost to calculate the rate by the sales tax provider. Okay? In addition, you have to file the return for each state, which a lot of them can be monthly and remit the tax. So if you're a small business, your cost of compliance can be quite exorbitant. Okay? That's the bigger issue that I also see besides just getting people out of the woodwork and comply. Because ideally what you want to do is to say, pick a rate for the state. That would be a lot easier to say, okay, if you're going to have to comply with the state of Utah, it's 7.5%. As opposed to calculating Salt Lake, calculating Provo, calculating all the little different jurisdictions. The only caveat that they've kind of mentioned so far, again, and we're just talking about in the early days of legislation, are states to offer some sort of reimbursement for the cost of compliance. And just so you know, all that the reimbursement is a very small credit that you get. So let's say, for example, in the state of Michigan, when you're filing a sales tax return, you're getting like a $30 credit. Some states may give you half of 1%. The purpose is what's called a vendor compensation or a reimbursement for your hassle of compliance. That's all that they've discussed so far, is providing for some provision of that. But to truly make it work, we do have to move along some sort of a harmonized rate structure. Otherwise, this is just going to get onerous, because right now, most pricing of software is per transaction and averages $1 a transaction. Yes, ma'am.
I contacted the BOE on this same subject.
Yes.
Does a small owner of a business have to collect all these city taxes, which is like, I think it was 75 cities across California.
Correct.
And they basically came back to me and said, most companies will do it as a courtesy to their client,
Yeah.
but it's up to the purchaser to pay use tax.
It is, but just because I've done numerous BOE audits, so where this district and local comes in, like, I'm going to use San Diego as an example. We have El Cajon, we have Nashville City, we also have Chula Vista. Within our county, they have a little special rate that the voters voted on.
Right.
Okay. If I have my business based in, San Diego, where those apply is that I'm truly kind of delivering or performing or doing the service in there. The true remote, what we call ship, UPS, FedEx, it gets transited there, and you have a lot of customers, goes up to LA, goes up to Orange County. That's your home rate. Plain and simple. You don't need to get in all the little nuances throughout the state. If it's a true mail order. If it's not mail order, for example, you deliver it in your own vehicle. We're not using FedEx, we're not using post office third-party company. But it's your own vehicle, different story. Or I made the sale. I send the technician. Something that physically got you there.
Right.
That's where BOE draws the line. Okay? So if they stay in their home area and it's pure mail order, you just use your home rate.
Right. That's exactly what it is.
Yeah.
Which is gonna save
But
them
when
a
you're
fortune.
talking to representatives from BOE, you'll get in terms of these mixed messages. But when I deal with actual auditors, this is where we draw the line. And that has been the rule from auditor to auditor. Are you delivering in there? Are you using your own vehicles? Are you sending technicians? No, we're just mail order. We pack it up, put it in an envelope, ship it out. They just go to the rate. Now, if I did collect, which is different, I may collect that higher rate. I may collect Santa Monica. I may collect those higher rates. I can't pocket it. Okay?
Right.
It's not a windfall, so you have to remit it back.
Excuse me.
Yes.
You said that California is an origin state?
Meaning where the purchaser is.
No, yeah, I
Yeah.
understand what that means, but my client got audited and had to pay when his destinations California, not, and you're gonna say,
Because they're a remote seller.
no, he bought from a remote seller, and that seller got audited in their state, and then California came and audited him, and they didn't call it a use tax.
That was a drop ship. Yeah. And we're going to talk about drop shipping. What's your name, man?
Yeah.
As Pat was talking about, that's a common example of a drop shipping because you're using two different companies. You have an out-of-state company and a company that's in-state, most likely California, fulfilling it and shipping it out. And we're going to talk about that, and that's a big hot-button issue with a lot of states. Because what you're describing, Pat, is a classic drop shipping example. Because it's viewed as two sales, and that a sale was incurred in the state of California. That's what happens. Okay.
Question.
Yes, sir.
The state Hawaii has an excise tax instead of sales tax, and they have a different rate by each item.
Okay, so the state of Hawaii, which names are Peter? Okay, Peter's talking about the state of Hawaii, what's called a general excise tax. What's different in Hawaii that, if you're paying attorney, accountant people like us, they charge tax. Okay? We're not used to that for professional services, but in Hawaii, it's pretty much on everything except for a few exempted products. Another difference with Hawaii, it's a very low rate. It's about 4%, 4.3. I like going shopping whenever I'm in vacation in Hawaii. It's like 4% going to Waikiki Mall. But that's kind of the difference is that they tend to tax everything with a few exceptions. The technical rule would be the difference. So if I pay 4% in Hawaii and I have, 7.75, I owe 3.75. That's the technicality. But as the whole point of this topic is anybody declaring it and is the state catching it? All the garments, all the things that people buy. How states catch it are in big items. You ever have any clients buy jewelry? And they bought diamonds and bracelets and gold, got shipped from somewhere else. Those bills of lading, that's how they catch on those items. Vehicles, any significant purchase, but the little stuff when you're going out on vacation, that's all meant to be voluntary declaration. But they really don't have any need to catch it. Yes, sir.
Okay, so we're talking about the U.S. and states. For example, there's some of us that do foreign taxes, and I'm just envisioning this world structure where I'm doing a Denmark tax return. They have a 46% tax rate over there, 48%, and us getting hit with that or other things because we didn't work over there. Do you see that coming?
That's the evolution that we're getting into. Because the benefit of the World Wide Web is that we can be here and we can sell in Denmark and in Singapore. But we're not there.
Right.
And that's the world where we're going to. and how to kind of go and enforce that compliance for someone who's not in their actual jurisdiction. We're moving towards that. And the OECD, the Organization of Economic Cooperation and Development, is trying to develop a series of rules, and it requires, the compliance of all the member states to follow a common set of rules. Because otherwise we're going to get into a situation where people go and look for what we call these tax havens, where I can go and set up shop and not be subject to that and income taxes and all that. Okay. I think we have about 10 more minutes before a break. Yes. Uh-huh.
And has nexus in Arizona and Texas.
Okay.
They can make sales from Arizona to Texas. It's not taxable for California because of the state. It's shipping yards. But since it's shipping in Texas and they do have nexus there, they need to report the tax in Texas. The sales tax in
You name SEMA? SEMA. Okay, so step one is
Bill,
what?
Would you repeat that?
Okay,
Here,
so as SEMA's talking about is that a client has nexus in Arizona and Texas, right? And makes sales into California?
and has
Has headquarters in California. And so there's
sales in all 3 different states.
California, Arizona, and Texas. Okay, so step one is what are we selling? Goods, services.
Goods.
Okay, goods, it's basically is we're shipping the goods and we're not necessarily transporting in our own vehicles. Okay, so the sale in Texas would be a Texas sale. Okay, the sale in Arizona would be an Arizona sale. Okay, for that example.
But for that sales is for since the owner has nexus in California. If California is easier example, they are selling in Texas to California and ship it to California. Since they are here, they are headquartered here, they should report the sales tax to California. But the sales was made in Texas.
But the benefit of it was received in California, the end destination on that, because it was a remote sale.
Yeah, it was.
Yeah.
It cannot be remote sale. Since they have nexus in 3 different states, and you have
Even though you have nexus in 3 different states, you also have to look at when we're getting into sourcing the actual sale, is the facts and circumstances of how the sales derived and where the benefit got received. So like, for example, company headquartered in California, but you've got products being shipped and orders taken from Texas and customer deriving benefit in California. The determination is going to be California on that sale for that type of sale.
California sales tax should have been
California sales tax, that's a California sale. Yes. Yeah. We try to look at the overall landscape, facts and circumstances of how the sales derive and how benefit is also derived, looking at that whole picture. Okay? We have any other questions? Okay, let's take as far as our first break, and we will be back. It's 9:30, so we will start at 9:50.